5 years of living it up, followed by a lifetime of paying off the debt. If you were given that choice, would you take it? The Japanese government once made that choice for its entire population. Japan is the only major nation on record whose per capita GDP has ever surpassed that of the United States. From 1990 to 1996, Japan's per capita GDP was consistently higher than America's, peaking in 1995 at a staggering 1.5 times the U.S. level. During this time, the Japanese were on a global spending spree. It was famously said that the wealth concentrated in Tokyo alone could buy the entire United States. When the Japanese look back fondly on the prosperous 80s and 90s, they often blame Americans for using the Plaza Accord to steal half a century of their economic progress. But in reality, the Plaza Accord was a failed attempt by the U.S. to save itself from a crisis similar to the one it faces today. The only thing the agreement really did was send the Japanese economy soaring to an illusory peak. As the Cold War reached a fever pitch in the 1970s, Ronald Reagan, who became president in 1981, faced a core problem: how to maintain America's dominance in the Western world and halt Soviet expansion. To keep the U.S. competitive, the Reagan administration pursued supply-side economics, centered on tax cuts, deregulation, and a massive increase in military spending. While these policies stimulated consumption and investment, they had two simple and direct consequences. First, the surge in military spending led to a ballooning budget deficit and soaring government debt. Second, to support Reaganomics, the Federal Reserve's high interest rates attracted a flood of international capital, which caused the U.S. dollar to skyrocket. From 1980 to 1985, the dollar appreciated by about 50% against the currencies of its major trading partners. A strong dollar was great for buying foreign goods, but it was a death sentence for American manufacturing. During Reagan's first term, the United States transformed from the world's creditor to its biggest debtor. The decline of American industry, combined with the strong dollar, created a windfall for other industrial powers in the Western Bloc, especially West Germany and Japan. As anyone who has watched Trump's crude tariff policies knows, the U.S. government has a consistent philosophy: you can have a taste, but you can never have the whole meal. So, when the U.S. trade deficit exploded from $36 billion in 1980 to $148.5 billion in 1985, Washington decided it had had enough. The solution they came up with then was no more sophisticated than the ones used today. The logic was simple. If Japan and West Germany were getting rich off the strong dollar, then the U.S. just needed to reverse course on the exchange rate and make it harder for them to do so. On September 22, 1985, the U.S. invited the finance ministers and central bank governors of the U.K., France, West Germany, and Japan to the Plaza Hotel in New York. There, they signed an agreement to collectively devalue the U.S. dollar against their own currencies. This was the infamous Plaza Accord, the agreement that would later be blamed for Japan's economic stagnation. While many believe the U.S. forced Japan into the accord, the reality is that, to a certain extent, the Japanese chose this path themselves. When news of the U.S. demand reached Japan, it sparked a fierce domestic debate. One side argued that a stronger yen would cripple Japan's manufacturing base, the very foundation of its economy, and that the agreement must be rejected. The other side, however, saw a more complex picture. Those in favor of the accord made two key arguments. First, Japan was overly reliant on exports. Its domestic consumption was too weak to absorb its own industrial output. To evolve, Japan needed to shift from a production-based economy to a more service and finance-oriented one. A stronger yen would boost the purchasing power of the Japanese people, unleashing domestic demand and accelerating this economic transformation. The second, more important reason was geopolitical. As the leader of the Western Bloc, the U.S. was shouldering the vast majority of the cost of containing the Soviet Union. If a chronic trade deficit bankrupted America, every other country in the Western alliance would suffer the consequences. For these two reasons, the Japanese government ultimately decided to accept the U.S. demands. In fact, it wasn't just Japan. West Germany, the UK, and even the fiercely independent France all signed on. Yet, in the years that followed, only Japan entered its lost 30 years. This wasn't because the U.S. was secretly targeting them. It was because, after the accord was signed, Japan actively chose the path of party for 5 years, pay for a lifetime. In reality, Japan's economy in 1985 was not in great shape. The country had a declining birth rate and a rapidly aging population. The economic boom of the 80s was driven by one single factor. Japanese companies had temporarily surpassed their American counterparts technologically, while still enjoying lower labor costs. Logically, Japan should have focused on fixing its demographic issues and maintaining its high-end manufacturing edge. The shift away from manufacturing was a gamble that could shake the very foundations of the nation.
But after the Plaza Accord, the Japanese government decided to floor the accelerator. They believed that by flooding the market with cheap money, Japanese companies could use the newly valuable yen to expand rapidly, while the Japanese people would become rich overnight. Starting in 1986, the Bank of Japan went on an interest rate cutting spree, lowering the benchmark rate to a historic low of 2.5% by 1987. As the yen soared, the Japanese people suddenly found themselves with unimaginable wealth. Foreign luxury goods and international travel seemed practically free. Japanese tourists and companies went on a global shopping spree, buying up everything from designer bags to foreign real estate. But most of this wealth wasn't real. It was credit created by the central bank's loose monetary policy. Having tasted the sweetness of a high exchange rate, domestic consumption went through the roof. The immense short-term profits from financial speculation made Japanese companies, once proud of their manufacturing prowess, start to look down on it. From 1986 to 1990, investment in manufacturing equipment plummeted. Export companies, facing losses from the currency fluctuations, jumped into the stock market to make a quick buck. This flood of money caused the Japanese stock market to quintuple in just 5 years. From there, the cash poured into the real estate market, fueling a speculative frenzy. A financialized economy is, at its core, a transfer of wealth. The first ones to get into the game made fortunes. Young people, seeing that speculation created dynasties while hard work destroyed them, jumped in too. Using a cycle of taking out loans to buy assets and then using those assets as collateral for more loans, many Japanese people mortgaged their entire futures in the overheated economy. The Japanese government knew this pulling yourself up by your own bootstraps economic bubble was unsustainable, but the long-suppressed desires of the Japanese people had been fully unleashed. The only question left was how to end the party. By 1989, the Japanese government estimated that the total value of Japanese land was 4 times that of the entire United States, and the Japanese stock market accounted for a staggering 45% of the global total. The only thing keeping it going was the belief that prices would keep rising forever and that you wouldn't be the last fool holding the bag. But every bubble eventually finds its last fool. To curb the endless rise in asset prices, the government decided to act decisively. If the bubble was caused by a flood of cheap money, the solution was to turn off the tap. In 1989, the Bank of Japan began a series of aggressive interest rate hikes, quickly raising the rate back to 6%. The moment the central bank acted, every speculator knew the game was up. The last one out would be the loser. From 1990 to 1992, the Nikkei index was cut in half, and then cut in half again. Tokyo real estate prices, once sky-high, fell by 70%. Those who got out fast still walked away with more money than they could have earned in several lifetimes. But those who were too slow were saddled with debts they would never be able to repay. Only then did the Japanese people begin to rediscover their once abandoned manufacturing sector. The old industrial base was strong enough that even after the bubble burst, Japan's GDP continued to grow on the embers of its manufacturing legacy. But by 1997, with the demographic crisis worsening, the Japanese economy finally ran out of steam and was snuffed out by the Asian financial crisis. In the eyes of the Japanese, the bubble economy was the root of all evil, and the Plaza Accord was its starting point. But in the end, it was all just a financial fever dream, and eventually, everyone has to wake up and face reality.